I think we will go up to, around 6,000, peak out around 6,000, something like that. You still have almost all the central banks indicate they're going to be buying. China's buying big time. And I think the basis for higher prices is all pretty much baked in the cake.
Yeah.
So it's from that point of view, it's a good buying time.
Economist Steve Hanke believes the long-term outlook for gold remains highly bullish as central banks continue accumulating record amounts of the precious metal. Strong demand from China and ongoing global reserve diversification are reinforcing gold's role as a safe haven asset. These powerful fundamentals have already laid the foundation for significantly higher prices, with gold potentially reaching $6,000 per ounce over time. As inflation concerns, geopolitical uncertainty, and de-dollarization trends persist, many investors view current price levels as an attractive long-term buying opportunity in the evolving global financial landscape. Now, we bring you exclusive insights and key market perspectives from Steve Hanke's interview before we continue exploring the latest developments in gold, silver, and the global financial markets. Make sure to subscribe to Bullion Nexus and turn on the notification bell so you never miss important updates, market analysis, and precious metals insights. Thank you for joining us. Sit back, stay informed, and enjoy the video.
Nothing has really changed in terms of the long run view of the secular bull market. We're still in it as far as I'm concerned, and I think we will go up to around 6,000, peak out around 6,000, something like that. And I agree, it has pulled back, but it's pulled back in the face of very strong dollar and higher interest rates. I think that those have been the two big headwinds. And there's also been some pivoting out of temporarily out of commodities into tech. That's the big picture. But you still have almost all the central banks indicate they're going to be buying. China's buying big time. And I think the basis for higher prices is all pretty much baked in the cake.
Yeah.
So it's from that point of view, it's a good buying time. The money supply is accelerating. If you use the Fed's M2 number, which is just a simple sum of the components that make up M2, you just add them up, and you get a number. That's M2, and that's been accelerating for roughly about 18 months, something like that. Now, one of the aspects and a big driver in M2 are loans made by commercial banks, and those have accelerated considerably. So that component is really driving the increased rate of growth in M2. If you look at it more broadly, and I think a better measure is what they call Divisia measures, where you take the components, instead of adding them up in a simple sum, you put weights on the components that make up the money supply measure that you're looking at, whether it's M2 or M3 or M4 is even better. And that we can get those numbers from the Center for Financial Stability in New York, where I happen to be a advisor. And they use what they call Divisia. And they measure the money supply, obviously M2, M3, and M4. M3 and M4 aren't measured by the U.S. Government anymore, by the Fed. And M4 really is the best one because that includes all the way out to T-bills are included in that. Now, the T-bill weight isn't as great, obviously, as currency because T-bills aren't currency. You can't go into a grocery store with a T-bill and buy groceries. Mm-hmm. You've got to exchange the T-bills for cash or money that you end up putting in your checking account that have a bigger weight, have more moneyness. So the idea with Divisia is you put weights on the components, and the weights are geared towards the degree of moneyness that is included in the component that you're including in the major money supply that you have. So Divisia M4 includes a lot of components. Each of them is weighted, with T-bills being the last one in the line on M4 and having obviously much lower weight than cash or currency or checking deposits, liquid deposits, or savings deposits. So as you go down the line, currency would have full weight, then checking deposits a little less weight, and then savings deposits, short-term savings deposits a little less weight, and long-term deposits even less weight. But they're all moneyness because you can exchange all of those components actually into cash and use it for transactions. So anyway, that's a little bit of a long-winded answer to your question. But if you really want to get at the money supply properly, the best way to look at it is with Divisia measures, that you have these weights, and look at it as broadly as you can with every asset that has moneyness in it included, and that would be the M4 measure. And you can find this. Just go to your website, Center for Financial Stability in New York. They publish this every month. They have a very detailed monthly report on this.
Gold's long-term secular bull market remains firmly in place despite recent price pullbacks driven by a stronger U.S. dollar and higher interest rates. Continued central bank gold purchases, particularly from China, alongside accelerating global money supply growth, provide a strong foundation for higher gold prices, with a long-term target near $6,000 per ounce. He also highlights the importance of Divisia M4, a broader measure of money supply developed by the Center for Financial Stability, as a more accurate indicator of future inflation and monetary expansion supporting precious metals. Let's get back to the interview.
Right now, Warsh has just come in. He's only publicly had one press conference, and the interpretation of that talk that he gave, the press conference, was that he was hawkish and in tone, and so that's kind of where the market is right now. We'll have to see, because he's not the only one that's voting in the open market committee. So I don't think things probably are going to change radically that fast. There might be changes. There will be changes. He's a new chairman, and I hope he orients himself towards the quantity theory of money. He's indicated that he wants to change things, and he wants to change the model that they use, and I think that's a great thing. He has a task force looking into, for example, squeezing down the balance sheet. That's great, but that's a great idea to open the door, take a new look at things. Obviously, things haven't worked very well because the Fed under Jerome Powell was a disaster. I mean, we've just been on a roller coaster ride with a huge increase in the money supply after COVID. Then we had a big increase in inflation as a result of that, and then they slammed the brakes on, and things started coming down, and now it's things are going up again. They took their foot off the brake. Remember, we had quantitative tightening until December of last year. Now we have quantitative easing. So they're looking at the data that come out every day, and the model that they have excludes the quantity theory of money. They don't even measure the money supply and have that measurement included in the post-Keynesian macroeconomic models that they have. So I hope Wash sees the light and says, if we're gonna hit the inflation target, whatever it is, we better be keeping our eye on the quantity theory of money and the money supply. But he hasn't really said that explicitly yet. Now, Jerome Powell, on the other hand, did explicitly say over and over again that the Fed did not look at the money supply because, as Powell put it, he claimed there's no reliable relationship between the money supply and economic activity, which is, of course, nonsense. Mm-hmm. But that's been the position, and Walsh says he wants to change that, but we don't exactly know what he has in mind, so we just have to wait. Well, it is a political issue because now about 22% of the taxes we pay go just to pay interest. So the taxpayers, the current taxpayer today is getting only, let's say, 80% of what they're paying in taxes is going either for government services or government transfer payments. About roughly 20%, slightly over 20%, is just going basically down the rat hole because you're servicing past debt. And the key thing with the deficits and past debt is that debt was incurred a long time ago, or sometime in the past. And many people paying taxes weren't even voting. Some weren't even born when the deficits were incurred. So it's a completely, I would say, immoral thing to be running these deficits because you have many people servicing that debt who didn't participate in any way, directly or indirectly, in the decision to incur the debt in the first place. So that the whole thing is bad from, let's say, from an intergenerational equity point of view. It's bad from a moral point of view. It's bad, and from do you get anything from that's worth anything from the taxes you're paying in? And right away, I'm telling you, 20% is taken off the top just to service past debt that's been incurred. So it's becoming an issue because it's big, and by the way, it's now that expense for servicing debt, interest, is greater than the huge amount that we spend on defense. And historically, there's something called Ferguson's Law. Ferguson's Law says that anytime interest expense exceeds defense expenditures, the empire goes south. It's bad news. It puts the government power in throws it into question. Let's put it that way.
The Federal Reserve is entering a critical period as new leadership signals a willingness to rethink monetary policy. He argues that previous policies under Jerome Powell contributed to excessive money supply growth, rising inflation, and economic instability. That the quantity theory of money should once again become central to Fed decision-making, warning that ignoring money supply has serious consequences. He also highlights the growing burden of U.S. debt, noting that interest payments now exceed defense spending, a development linked to Ferguson's Law, which has historically signaled weakening fiscal and economic power. We would love to hear your thoughts on this analysis. Share your opinion in the comments below and let us know how you see the future of gold, silver, and global financial markets. If you found this video valuable, make sure to subscribe to Bullion Nexus and turn on the notification bell so you never miss our latest market insights, precious metals updates, and economic analysis. Thank you for watching Bullion Nexus. Stay informed, stay prepared, and we'll see you in the next video.